Fools, Janet Yellen is testifying before Congress this week in an effort to become the first woman to head up the Federal Reserve. And so a lot of people are trying to guess, what's the Yellen Fed going to look like and what impact is it going to have on you and everyday Americans as they plan their financial lives? My name's Dan Kaplinger. I'm the Motley Fool's Director of Investment Planning. And today I want to take a look at the Yellen Fed and ask one question. How are low rates that could last as long as 2017 going to affect you? Now, we've heard a lot about Janet Yellen and her emphasis on employment. And the first thing that everybody knows about the U.S. economy's recovery is that employment has been sort of a lagging indicator. Jobs growth hasn't come as quickly as many people would have hoped. And as a result, unemployment rate gains have usually come not from job growth, but from people actually leaving the workforce permanently, which is not an encouraging sign. And so a lot of people expect Janet Yellen, if she heads up the Fed, to be even more dovish about leaving low rates in place as long as possible in order to spur that job growth. And that's going to have a big impact if it comes about on a number of industries. For instance, we've seen home builders like Pulte and also banks like JP Morgan Chase and Wells Fargo really see the impact of higher rates in the mortgage market affect their businesses. For home builders like Pulte, what it does is it reduces the affordability of the houses that they're selling. For JP Morgan and Wells Fargo, it hurts the number of people who can do refinancing transactions on their mortgages and also prevents some would-be home buyers from making an outright purchase of a home. And so if those rates stay low, it could actually even spur low rates on the long-term side to fall from their recent rise. And that in turn could make housing more affordable and spur those businesses forward. Now similarly, you can see the bond market start to rebound. A lot of conservative investors were really surprised at how much money they lost in bond funds in the middle of 2013 when these interest rates began to rise. But if people are confident that the Yellen Fed is going to keep rates low for an extended period of time, then you might actually see those bond rates start to reverse and head lower. Now finally, if that happens and you have short-term rates staying low for years to come, it's going to make leveraged investments look a lot more promising because they're going to be able to rely on cheap financing going forward. As a result, some of the big declines you've seen in mortgage real estate investment trusts, companies like Annaly Capital and American Capital Agency, might actually reverse themselves and start to move up as investors realize that they might have another 2 to 3 years to enjoy the fruits of a big gap in interest rates. So it'll be interesting to see as the confirmation process moves forward to what extent Janet Yellen gives more details about her long-term plan for the economy and whether Congress is happy enough with that to go ahead and approve her to become the first female chair of the Federal Reserve. Now for more on interest rates and making sure you protect yourself, be sure to stay tuned to Fool.com. Thanks for watching, and Fool on.